Yo. Hope you're doing great as always. Just want to shoot you a quick video, a little bit back to the basics we are having today. And the reason I wanted to do this video is that, back in 2017 when I was starting investing and everything was just like, brand new and I didn't know what I was doing. And this is one of the things that I wish I maybe understood a little bit sooner, because of course, when I started investing, it was just, okay, let's start buying with this company. It's a great one. Actually, it was Apple, my first stock, right, which obviously turned out pretty well. But the first year of investing, that's a hard endeavor, right? Whenever we try to be great at something in anything that's worth doing as us as humans, whether it's career or could be something as being great father or great mother, right? We need to cover some of those really like foundations and make sure that we understand what we are doing, right? And we also do it with intention, right? Having that plan a little bit, at least in investing, 2-3 years out, and plan out how we want our portfolio look. So it's always the question, which companies should be in our portfolio, right? And the three categories I will be talking about, that's obviously the growth stocks, value stocks, dividend stocks, and what role they should play in our portfolio. Should we have all of them? Should it be like an equal weight? And that's obviously the question that you need to answer yourself, right? Depending on where you are in your stage of life. Also, could be a personal preferences. But it's important to understand this distinction, and of course, as anything that we humans think about, it's a little bit an arbitrary distinction, but it's a distinction nonetheless, right? And some of the companies might fit into more of these categories or a little bit like in between. But in kind of like the core essence, let me kind of go through them and tell me a little bit like what are the pros and cons, right? As with everything, it's not black and white. There are definitely advantages, there are disadvantages. So let's dive into it. So first category, I started with growth stocks for probably the reason that it's one of the most, let's say, the most sexiest category, right? It's always the companies that everyone's talking about, whether it's on like the traditional media, CNBC, or on social media, YouTube, Twitter. Like everyone is interested in that, new thing that's happening, and, the company that's growing fast, and, like it's very enticing. And that obviously makes it, innately we humans love when there is, something new and something exciting, right? So we might be a little bit like, tied to these companies, or and also with that promise of obviously higher potential gains, because some of these growth stocks, when they actually perform, they provide some of the best returns in the stock market you'll ever see, right? Which obviously excites people even more. And that, of course, is basically its own con, right? Because that also means that for every company that's, that provided exceptional returns for its shareholders, there are many that will do, not so good, and, plenty of those companies will fail. So, maybe as a practical example, with electric vehicle companies, obviously we have the Tesla, the undisputed king that, made so many millionaires. But at the same time, you have so many other companies that are if I put it mildly, that they are struggling. So, your Rivian, your Lucid, there was this VinFast IPO recently that was also a little bit debacle. So, and that means that the growth stocks are inherently, the toughest companies to invest in, right? And, actually, if you are new to investing, I would recommend to be definitely a little bit more careful with these, right? So it's definitely one of the category that we just need to understand the company through and through, right? Compared to value stocks or dividend stocks, which we will go through a little bit later, these are slightly easier, right? They are a little bit more mature companies. There are formulas that you can employ. Not with the growth stocks. With the growth stocks, you just really need to understand the company and their trajectory into the future, and also understand the possible variance of the possible outcomes, right? So, never take the management at a face value, run the scenarios, what will happen, hey, if the management is correct, if they are maybe, painting a little bit rosier picture, even if we fall short by a certain margin, is the stock still going to appreciate even in that negative scenario, right? So really, always take it with a big boulder of salt. And so be very careful with these. But again, like when you hit one of those, it's definitely worth it. So you can hear it in my voice, right? There is this inherent tension that okay, it's something riskier, but as long as you understand it, do the work, and have some experience with it, okay, then you'll do just fine. So these were the growth stocks, the dangerous but very enticing category. Now we are having the value stocks. So value stocks, those are your, little bit usually bigger, mature, proven companies with a long track record, companies that have been here oftentimes, multiple decades. These are relatively stable companies, which also makes them easier to value, right? So even for someone who's relatively new to investing, it's relatively, basic arithmetics, right? See where the revenue is, how it's growing, where it can be in a few years, see where the net income might be, then understand your ratio, usually price to earnings ratio is for these stable, profitable companies. Understand if they are at a, fair value, overvalued, undervalued. And then, of course, you can see that, hey, maybe the company is fairly valued, it's still, growing a little bit, it's probably going to be fairly valued, moving into the future. And you can make relatively safe assumptions, right, about the trajectory of the company based on that. But it also means that, since it's a little bit simpler and a little bit, again, that proven track record, it's usually offering only moderate gains, right? Unless there is a scenario where you find value companies that are significantly undervalued, right? Which, of course, again, comes with a little bit additional skills, right? So as an investor, even like, normal individual guy, like you and me, like we can do quite fine in the market, right? As long as we spend a little bit of time, we will quite likely beat the market. As long as we spend the time, a few hours every week. But then, of course, if we go maybe a little bit more, more in depth, learn the valuations, learn how the market moves, learn different players, then we can do, better than the market with a significant margin, right? So obviously is that play that, hey, as long as we put in the effort, as long as we put in the time, we'll get better results, right? Simple as that. So possible even with the value stocks, but then we have to be a little bit more, it's about the valuation in this case, right? Find the companies when they are undervalued and let the market do its way and, let them return to their kind of like the natural habitat. So that would be the usual value play as long as we want to go a little bit more aggressively. So those were the value stocks, right? Second of the three categories, and the last but not least, dividend stocks. So that's a little bit almost like a subcategory of the value stocks, but basically it's those bigger, stable, mature companies that can afford to pay a stable dividend, right? So, basically it's usually every quarter that the company pays dividends to its shareholder, which means that, hey, if you hold the company in your portfolio, every quarter you can expect money to be deposited in your account, which obviously feels super, super nice. Some people prefer these types of stocks. So, kind of slowly build that nest egg and slowly basically, let's say, replace your regular income. And, as long as people are consistent, they can really build a solid dividend portfolio in a matter of probably a decade, 15 years, depending how aggressively we're investing, and completely replace their income, right? And same as the value stocks, the dividend stocks are usually a little bit easier to value. And they benefit both from that cash flow, right? From the dividend that you are getting paid. But in ideal scenario, they should also appreciate, year in and year out. So you can have that nice, like the two-way appreciation that at the same time, hopefully you bought the company when it was maybe a little bit undervalued, hopefully, and it's slowly getting, more valuable over time, which is also a little bit of an interplay of the management team, right? Because when they are paying you dividends every quarter, it also means that they don't have that much money on the balance sheet or for growing the business, right? So that's a little bit that, like a kind of like the stark contrast to the growth stocks, where, those are often, in the early stages, they are unprofitable. Everything is aiming for that growth. But dividends, it's for some, bigger company that they don't have a way to grow, right, at this point, because they've just became so big that they, they might have saturated their market, right? So then what's kind of like the second best thing to do once you really reach that stage where, hey, these companies are producing stable cash flow, but there is not that much room for any additional growth, or basically any additional growth would be too expensive. What you can do, okay, you can pay the dividend, you can do some buybacks, financial engineering, returns value to the shareholders, nice and easy. Of course, with dividend stocks, the upside is a little bit limited, same as with value stocks. It's usually those companies that are a little bit more mature. So, and then maybe one more caveat, be careful if the companies are offering too high of a dividend yield. That's often a little bit suspicious, right? So then you need to dig a little bit deeper, understand things like the payout ratio, how much is company paying in dividends rather than, keeping for the company itself, either put it on balance sheet or for growth. Also, obviously, dividends are not guaranteed. So, some companies might cut their dividends, if the business is not doing well. And so that's obviously the inherent risk, right? But that's with everything. So I hope this was helpful. Let me know which maybe category you prefer the most for your portfolio, or what would be kind of like the distinction, right? If you have your portfolio, do you have like each of those categories in equal weights, or what do you personally prefer? Because if I can tell you a little secret, personally, I don't like dividend stocks that much. And it's mostly because, okay, if you are getting the dividends, you are getting taxed on those dividends, right? So you are basically a little bit interrupting the compounding. So when you are, as long as you have more than 5, 10, 15-year horizon, then, why would you want to have the dividends, right? So that's a little bit my personal. Also, the growth stocks are my personal favorite. But I'm also putting a lot of time into the research, right? So, if you're going that way, just make sure that you know what you're doing, right? So you don't get burned. We've seen how it, kind of... remember, 2021 is just 2 years back, but it sounds like people already forgot what happened, right? So be careful. Like, if you overpay for a company, it might take a long time until it corrects itself and you might be in the green again. So yeah, be careful out there and talk to you soon.